In this example, we are going to look at the straight line method. We have Chester Corporation issued $4 million in 8% bonds with a 10-year, well, they're 10-year bonds, and he issued them on February 1st at 115. Semi-annual interest payment dates are January 31st and July 31st. And we're to use the straight line method and ignore year-end accruals to answer the following questions. So a couple of things I want to point out in here is that our issue price is the $4 million and our face rate is the 8%. The face rate is the amount that will be used to calculate the cash interest that's paid out to the bondholders. The fact that it's a 10-year bond is important because at the end of 10 years, maturity date, that's when the bonds will be paid back. So when investors buy bonds, they're going to get interest and they're going to get their face value back in the end. The fact that it was issued at 115 means it was issued at a premium. 100 is our par level. Anything under 100 means it's issued at a discount, and over 100 means it's issued at a premium. So basically what's happening is the investors or the buyers of these bonds are willing to pay more than face value, in this situation 15% more than face value, because of the rate that they're going to be getting. Other bonds in the industry are probably paying lower interest rates, so they're willing to pay a little bit more up front because they're going to get more paid out in interest. Okay, so we're going to look at each of these different scenarios one by one. So the first A wants us to know how much cash is received. So like I said, the investors are willing to pay a little bit more. So even though it's a $4 million issue, we're actually going to receive $4,600,000 in cash upon issuing it. So what's going to happen is that's going to leave us with a bond premium amount, a little bit extra. Because the bonds payable amount in every situation, regardless of how it's issued, bonds payable will always be credited for the face value, the $4 million in this situation. So the difference between the bonds payable amount and the amount of cash actually received is called unamortized bond premium, because we received $600,000 more. Now if we received less, it would be called a bond discount. If it would have been like 95 instead of 115, the difference would go to an account called unamortized bond discount. Now in part 2, we're wanting to calculate the cash that's paid in interest. So now we're talking about the interest payment dates of January 31st and July 31st. So to calculate the amount paid in interest, I said we use the face rate, which is the 8%. So the cash paid in interest is going to be the face value, which is the $4 million. We don't take into account the 15% above, times the face rate of 8%, and then times 6 over 12. So the reason we do 6 over 12 is because they're semi-annual interest payments. That means they're going to pay interest twice a year. So they're going to pay interest every 6 months, hence the 6 and the 12. You could also just divide by 2 if it's semi-annual. So the cash paid in interest every 6 months is going to be $160,000. Then it wants to know the amortization of the bond premium, because what happens is we have that $600,000 sitting there in our unamortized bond premium account, but we need to spread that amount out and amortize it over the life of the bonds. So the fact that we have $600,000 and we have 10 years and we pay semi-annually, we're actually going to divide by 10 years times 2. So we would actually take that $600,000 divided by 10 and divided by 2, which that's where the $30,000 comes from, because the 10 years we're actually paying interest 20 times because of the semi-annual. Then for our interest expense, the interest expense is going to be the difference of the cash paid and the amount that we're going to amortize. So our interest expense would be $130,000. So the way this would work is we would debit our interest expense for $130,000, and we would debit our unamortized bond premium account for $30,000, and then we would credit cash, decrease cash for the total of $160,000 that we're going to pay out. Now because we're using the straight line method, if you remember with depreciation, straight line method, depreciation was the same every year. And that's going to be the same idea when we're talking about bonds. So you look at part 3 and it's exactly the same. And it will be every 6 months for the next 10 years, the journal entry and everything will be calculated the same.